Okay, let's go ahead and go through the solution to the fourth question. On January 1st, 18, big company acquired little company in a transaction to be accounted for as a merger. On the date of acquisition, little company had the following information. And again, we've got the trial balance, both in, or basically the balance sheet, both book value and fair value. Again, we're always going to assume, unless otherwise stated, that we have a December 31st fiscal year end, which means that on January 1st, 18, there are no revenue, expense, or dividend account balances yet. So basically all we have is the balance sheet. And first order of business is to realize that, again, book values are completely irrelevant. So I'm going to go ahead and X that out. Okay, so what do we, this is the bundle of assets and liabilities that we're acquiring. In addition, Little also has in-process R&D with an estimated fair value of $50,000. They had also filed a lawsuit against a competitor and were expected to prevail and be awarded $30,000. So again, these are both things that normally wouldn't be recorded if we were doing them on our own, if these were transactions that our company had been engaged in. But since we're buying another company that has these contingencies outstanding, we are assigning some of the value, some of the purchase price is being ascribed to these two items, the in-process R&D and the contingent lawsuit gain. So those go into the bundle of assets and liabilities that we're acquiring. So first, let's go ahead and figure out the fair value of the net assets. And again, basically we've got the cash plus inventory plus equipment plus buildings plus patents minus accounts payable minus bonds payable plus the $50,000 in process R&D plus the $30,000 of contingent lawsuit gain. So the fair value of this bundle of assets and liabilities that we're acquiring is $650,000. We're going to pay $600,000, which means we're going to have a bargain purchase of $50,000. So let's go ahead and record this acquisition. And again, basically we're acquiring this bundle of assets and liabilities. I'm going to go ahead and be lazy here and copy and paste and then clean it up a little bit. Basically, we're not going to have the accumulated depreciation. We're not going to have that. We're not going to have the goodwill. So this is the bundle of stuff we're acquiring. So what do we have? Cash and receivables, inventory, equipment, buildings, patents. We also have the in-process R&D. And we have the contingent. It's hard, this is not the sort of thing we normally record. So what do we call this? A contingent receivable, contingent lawsuit receivable. I'm just going to call this contingent receivable. Again, sort of unusual thing to have. We're also assuming some liabilities. $20 and $190. And what are we paying to acquire all this? Well, we're paying cash of $600,000. Okay, second issue. Assume that Big pays $600,000 in cash to acquire Little. After the acquisition, it was discovered that the inventory fair value of $70,000 was incorrect. Since the inventory included some worthless goods, these worthless goods had been estimated to be worth $10,000 at acquisition. So basically that $70,000 inventory value we recorded was incorrect, assuming that we're within the remeasurement period. Again, we're given some window of time in which we can reevaluate the fair value of the assets and liabilities that we've acquired and assumed in the transaction. Assuming we're within that remeasurement period, we're going to go ahead and reduce our inventory, saying, look, of that $70,000, $10,000 really doesn't exist. And that's going to go ahead and reduce our contingent gain, which I forgot to record in the above entry. So let me go ahead and bring that down. And I was, as I was typing this, I was thinking I really should do the check figure, make sure my debits equal my credits. if I had been prudent enough to do that, debits 50 plus 70 plus 80 plus 500 plus 80 plus 550 plus 30 minus credits minus credit minus credit, that wouldn't balance. I say, oh my gosh, I'm missing $50,000. What is that? Well, that's my gain on acquisition, my bargain purchase gain. So an object lesson for myself to always do those check figures. In any event, we had a $50,000 gain on acquisition. Gains on acquisition, again, those should be viewed with a real degree of suspicion. And in fact, that gain on acquisition wasn't as big as we thought it was. We still have a $40,000 gain, but it wasn't as big as we thought it was.